Hi again. In this video, we want to take a look at your cash flow analysis and your financing analysis. This is a really important screen to look at because it's going to give you a snapshot of what your business is doing. Is set up to give you 36 months worth of income, expenses, profit loss, cash flow, and our other measures straight across. I broke them out into color groups. So let's start off by looking at your profit loss. Clearly, it's pretty easy. If you mouse over this, you'll see what all these things mean. So it's a good help. Profit and loss is simply income minus expenses. If it's red, you're losing money. If it's black, you're making money. And this is monthly, so it's not cumulative. This is your monthly profit and loss. Cumulative numbers are shown down in the bottom. So you'll see your cash balance. You can watch it grow, get pretty big. So up to about 53,000 and change here. So what is cash flow as a post-profit and loss? Cash flow is almost the same, except it also includes repayment of principal on loans or other advances. Now, repayment of principal is not an expense. So while it doesn't impact your profit or loss, it does impact your cash flow because you're paying that money back. And then you need to have the money in your bank to do it. So we'll get to that in a minute. So you can see that you'll see some of the other measures that all impact your cash flow. And let's look on the finance side. You have three options here. You can do a new conventional loan, you can do a merchant or cash advance, or a business line of credit. We also have leasing. So I already put some leasing data in here on the next tab, so we have something to start with. And as I mentioned, your balance sheet here. Your cash balance, this is your cumulative cash balance, which is your cash flows. The worse it gets, the higher this number gets. So when you start going cash positive, the number goes down. Your credit balance is the amount of money that you owe across all your borrowings. Right now, we didn't borrow, so it's at zero. And of course, your cash equity, which is basically the difference. And then you have some charts and graphs that you can work with for you to put into your business plan. So how do we fix this? Because you cannot run in a deficit. You got to pay your bills, or unless you want to go bankrupt. So in this scenario we have here, unless you're going to self-fund your business to the tune monthly and cover that, I mean, that's fine. But you may want to say, look, I need to borrow money, or I need to have that money up front. But at least you know what you're looking at. If you don't want to fund $50-some thousand, you say, well, we got to look at financing. So we click on a financing tab. Now, this is one where you need to work with your business loan broker or your business bank lender. Let's assume that you or your partners are going to put in $15,000. Let's put that in new equity. So that means financing needed is $38,000. Let's look at some of our options. You can do a conventional loan if your credit is good enough. So this is not easy for everybody. But let's say for a new loan amount, we're looking at $50,000. And you have a choice of it being amortized or interest only. It's a drop down. You can do interest only or amortized. Interest rate, let's say 4.5%. Number of monthly payments, 24. Keep in mind, this is not a mortgage or a car loan. It's a business loan. Terms are usually not really big. Loan origination fees might be $2,000. The cost of money to get that, leaving you with $48,000. What you see here is your monthly payment, $2,182. And I'll show you something else. So let's say that you're going to put this into play June 2nd. And we see that. So there's your first payment date. Again, this is a planner. So I'm not looking for exact when you're paying it back. First date is a month later, and then 24 payments. There's your bit. So no balloon payment. You say, well, what's that? Let's assume that you're able to get interest only. Well, this is nice. Your monthly payment goes down to $188 because it's only the interest on the borrowed money. But at the end of the term, you owe $50,000. So that might work. It might not work. So let's look at amortize. If we go now back to the cash flow analysis, you're going to see some new numbers. You're going to see that the $50,000 is being added. The lending fee of $2,000, and what we have here are your principal payment and your total interest. As you can see, the interest goes down, principal goes up. Here is your monthly payment. Here's the interest expense on this, and you see it matches because this is going to be a summary line up here of all interest and your new loan principal. If you look here, you'll see that your cash balance went up because you just dumped in $48,000. So when you factor that in with whatever the losses were, or the cash flow, you're cash flow positive in this month. Your cash flow positive, your cash balance is now positive and starts going back to negative again because you're picking up all these additional negative payments. So this is where if you look at this, say, well, that's not enough money to get us through because I'm still going to go negative. Well, you're right. So again, the purpose here is to show you how this works. Let's go back to the financing tab. And in this case, let's take this out and say, well, let's leave it in. I'll show you something else. Merchant cash advance. The merchant cash advance or just a cash advance is where the lender advances you money. It's not considered a loan. It's an advance against receivables. So they'll garnish your business income at whatever rate or dollar amount that was agreed upon to pay it back. So let's assume you're doing a $50,000 cash advance and your factor rate is 1.3. I don't want to get into factor rates here, but factor is basically the equivalent like an interest payment. It's a factor of 1.3. You'll see what that means. It means you owe a total of $65,000 back. These are usually short payment periods. They're not long. They can be painful. So let's say 12 months. So what does that mean? Your monthly repayment is $5,000. Your total to pay back is $65,000, which means you're paying a $15,000 privilege for getting that money. And a lot of times you can get these without really good credit. So that's why sometimes business owners do this. And your average percent of your gross income is about 19%. So you need to look at this and say, can I afford to pay 19% of my income off the top just to pay this loan back? So your monthly fee expense, if you break this down, the fee expense is the deductible interest that you're paying, or fee is $1,250, and repaying the advance $4,100. That's not deductible because you're paying back in advance, but it will impact your cash flow. So let's assume that the funding date on this is going to be 8/2/22. So your first payback date and your final date. So let's see what this means. If you go back to your cash flow analysis, you'll see this hit your tally here. So $50,000 cash advance fee, your principal payments, the summary of your principal payments, which will, again, the first payment starts the following month in September. So notice how it jumps to $6,000 in September because that's when that big number hits on paying back principal. And your interest expense goes up as well, too, as you can see from the $180, which was on the $50,000 loan. Now it's $1,400 because you just added another a cash advance. So it's more money you got to pay. So that we looked at the conventional loan. Here's the cash advance. So you can see with money hit your account in August. So in July, here's your payment. As you can see this, it'll be 12 payments. And if you go across, you'll see the payment stop after 12 months. Beautiful. Here's your fee expense, $1,250, and then the principal repayment. And as you can see what this does to your cash balance, you now have a healthy cash balance. And if you look at this, you're saying based on your income, look at the cash balance line. It doesn't go red anymore. So based on the scenario, you don't need to borrow any more money. In fact, you may get to the point where you can start paying some of this back. And if you look on cash equity, finally in month 19, you're $10,000 positive balance now. So that's good. So that means you could start paying some of your other borrowed money back. Now, your cash advance is being paid regardless. That's a fixed amount coming out. But once that's done, again, it doesn't look like you need any more cash. So if you have any other loans, you now have the cash flow to pay other loans back. So let's look at the third option you have here, business line of credit. So for this, let's take out this conventional loan. I don't want to put too much in here. We'll remove this, take all this out. Bam, and let's look at a business line of credit. Business line of credit is almost like stacked credit cards. I mean, some of the places that the vendors we work with can provide you up to $100,000 in line of credit, which is basically credit cards that are done the right way, where you're able to get all these without screwing up your personal credit score. So let's say you have an initial $80,000 line of credit. Now, origination fee. All lenders in this business have an origination fee. It could be 9% to maybe 11%, ballpark. So let's go with 10. So once you accept the money, they take 10%. So let's say your first drawdown date is 6/2/22, and there's your first payment date. And year one APR, year two. What's beautiful is some of these credit card, these business line of credit, your first year interest rate is sometimes 0%. That's really good. So that kind of negates the cash advance fee that you have to pay, origination fee. So let's say, and then it goes up to, let's say, 14 and then 15. Now, what's this last line, the minimum payment percentage? On almost all credit cards, you have to make a minimum monthly payment of 2%. That's just to ensure that money starts being paid back. So check with the lender broker you're with what that minimum payment is and put that number in there, because that's just going to impact your cash flow. So if we go back and look at this, so business line of credit, we haven't done anything. We haven't taken any money, but like you're saying, why do I got payments here? If you're looking at for M5, well, because that's the cash advance, the origination fee that you have to pay. And notice the interest portion is 0. Why? Because it was 0%. And all of a sudden, then in month 16, M16, it goes up to $80. Well, that's because you're now paying interest. So you have and less principal is being paid. So this planner accounts for all this automatically. And if we now look up here, you'll see that the cash advance, we still had that in there. So, and then your we didn't take that out. So we went back to June, where the business line of credit block drawdown, $8,000. That's the origination fees, but you didn't really take any money out to use. So how do you do that? Well, you go down here, you pick a date and say, let's say it needs to be after that. So draw down business line of credit 6/2, draw down would be when it first went in. So let's say 6/10 is your first. Let's put that in. And let's say you're going to take out of that, you're going to take in, let's say it tells you it's $72,000 to work with because you haven't made any payments yet. You paid $8,000. Let's say you're going to take $40,000 out of that. Well, there's your new balance. Your available credit is 32. And how does this look? Well, in that month, you took $40,000 for an $8,000 fee. So you took $48,000 out. Now you're going to start making these payments again here. So if you look under business line of credit, you'll see that we had no zero interest. So your minimum payment, it was 2%. So we're saying 962% of 48,000 is 960. We're not allowing for variable payments in this. Again, this is a planner. This is not an analysis tool. So we do give you the ability to pay back your principal, and I'll show you that. But based on your minimum payment, how it's going to affect your cash flow, that will be all factored in up here. Just keep in mind that it's all subtracted out from your cash flow. But you'll be able to see that whether or not you can afford that or if you're going negative. And as you can see, your cash flow, even here, you're still going to have some negative money, but hopefully you got that all covered. What you want to look at is your cash balance. So this means that if you say, well, I borrowed this money, why am I still negative in month 7? Well, because your business still has a loss and your cash flow is even higher negative because you're paying loans back. And say, well, how am I sustaining that? If you look down here for your cash balance, you're in good shape starting in month 6 with the borrowed money. So as you can see, you're fine. You don't have to worry about it. So you have enough money to cover negative cash flow. And this is all of the what if planning that you can do to make sure that you don't continue to have negative numbers. And if you go across on the cash balance, you are fine. So any negative cash flow you have monthly is being absorbed by your cash balance. So that's your working capital that you have to deal with it. So that's kind of how this works. It's just a great planning tool. What I mentioned about leases. So let's go back and look. Again, you can add more. You can say, if I put another date, let's say I'm looking at, I want to take more money out for something on 8/20/23. Well, it tells you right away you're going to have $42,000 because you, over this period of time, you would have paid back almost 10,000. It's like, great, I have 42,000 to work with. So if you're going to take out 10,000, $10, that's not nothing. There you go. So 3243. So you can borrow money. This will show your available credit, and really it's based on making your minimum payments back. So what happens? You want to make extra payments. You want to say, well, I want to pay some of this back. So let's say on 12. Let's do this. Yeah, 12, 10, making up numbers, 22 or 23. You want to pay back. It's going to tell you here you owe $46,000 by that time. So all right, great. I want to pay back 30,000. That means you're going to owe 16. And keep in mind that you may say, if I subtract 30 from the other number, why isn't it exact? It's because of payments that are being made over that time. When I put this together, it took me a while to understand the concept. Why my numbers weren't exact is because I wasn't accounting for payment made or repayment of a principal. So how does this look back on here? So this was 12/10/2023. So that's going to be December, and it's going to be December of the following year. So as we go across, what do you see here? $30,000 additional principal payment. You have the cash to do it. So yeah, look at this. So you have no problem in being able to do this. So if you notice what happened here, your cash balance went down. So your credit balance went from 46,000 to 16,000 and change. So this is how you can plan this out to show how you're going to pay your money back. But the key thing is to make sure you have the cash to keep your business afloat. And that's the beauty of this. So you can continue to reflect up to 6 of these. In reality, you can do more than 6 drawdowns and pay back more than 6. But for the planning tool, for the work, the calculations go into this, we're leaving it at this. And then finally, we have equipment leasing, operating and capital leases. So I don't want to get into differences between these, but basically capital lease accounts for an asset value that goes on the books, and operating lease does not. And what I'm just kind of showing here is dates when you put these in service, monthly payment, and the lease duration, and kind of what it was. And TBD, I didn't put something down this last one. But you have the option. These are drop downs. So you can select operating or capital lease. Doesn't change anything here. It changes on your balance sheet what the impact is of that lease. If it's an operating lease, this $10,000 asset value does not go in the books. If it's a capital lease, it does. I'll leave it at that. There's a lot more to it, but check with your accountant if you're an accountant or whatever vendor company that you're working with on leasing. They'll be able to give you that information. And that's it. So the whole point here is to let you show how you can use our planning tool, our planner, business finance analyzer, to show your cash flow, your profit loss, and where you're going to need financing, how much you're going to need, and what the impact of making those payments back is going to have on your overall cash flow. Thank you.